Does the Nippon Steel transaction on in terms of US Steel, does that have any kind of impact on your US business whatsoever as well? Because I would imagine that with consolidation will potentially come lower prices.
Well, what we've seen with consolidation over the years has been really some strong supply-side discipline as the mills have managed their assets and their facilities. Look, I don't see any major change in terms of the potential Nippon ownership of US Steel. What it has done, though, Will, is, I think, confirmed our strategy and the valuation or the undervaluation of US steel companies. We still feel very confident about the medium and long-term outlook for North America, particularly with all the investment that's occurring in that space, much of it steel intensive. So from my perspective, I think the most important thing about the Nippon Steel move on US Steel was the fact that Nippon Steel, large global companies, see enormous value in the US steel market going forward.
And you jumped on exactly what I wanted to ask you about next. So let's say this transaction doesn't go through because there's a lot of hurdles for it to get through. And, you know, we've seen that massive consolidation coming through in the United States. Are you looking to potentially get even more acquisitive in terms of the United States, or just up your production or your output in the US as well?
Well, what we've done over the last couple of years is actually increased our production at our mini mill at North Star. So we've gone from 2 million tonnes and we're currently in the final ramp-up stage to expand that to 3 million tonnes. So whilst it wasn't an external acquisition that might have got a few more headlines, it's been a really positive project for us internally to expand our capacity by 50%. So that process is well underway. We still think there's an opportunity for us potentially to eke another 500,000 tonnes out of our existing assets by improving the processes that we have. And we've announced in our results today the potential for us to look at actually filling out some of the midstream wills. So looking at cold rolling and metal coating that will take product from North Star, we'll add further value to it and then put it into our recently acquired paint lines, the BCP business. So we're looking at building out some of that integrated supply chain in North America.
Interesting. How are you looking at the prices of iron ore going forward, you know, as a key raw material cost, and also the fact that, you know, obviously we have China markets coming back online after the Lunar New Year break. What's your sense about China demand?
Look, we're still seeing China demand's obviously soft internally. There's a large amount of export that's coming out of China that's gone into the Asian region, and that's had an impact on spreads. So right at the moment, we're in that situation where production remains high in China. That's what's keeping iron ore and coal costs high. But domestic consumption has been lowered and we're seeing quite a bit of volume exported into the Asian markets. So spreads as we define it, or the difference between revenue and raw material cost, is quite soft and historically quite soft. It's why we work so hard to make sure our businesses are cost effective. It's why we continue to push, in Australia in particular, into value-added products to remove our exposure to some of those commodity products, because commodity steel spreads right now are at historic lows.